when a company decides to go public, it's required by the Securities and Exchange Commission to file an S-1 prospectus. Historically, these are some of the driest documents ever committed to paper. They're written by corporate lawyers for other corporate lawyers to ensure that no one anywhere is ever accidentally entertained. But 2 days ago, SpaceX filed its paperwork to go public, and reading through it, it became immediately clear that this was not going to be a typical legal disclosure. For a start, it opened with 14 pages of photographs of rockets and satellites, which called to mind Adam Neumann's ill-fated WeWork prospectus, which famously opened with the line, "We dedicate this to the energy of we, greater than any one of us, but inside each of us." That document was later described as one of the worst IPO filings in Wall Street history. The SpaceX prospectus is similarly unconventional, though I will say the rockets are more photogenic than the WeWork community photos were. The document is also filled with phrases that I'm fairly confident have never appeared in an SEC filing before. Under the business strategy section, right alongside standard disclosures about lease agreements and accounting standards, management explains that their primary objective is to extend the light of consciousness to the stars, a phrase that appears 10 separate times in the filing, which suggests it wasn't a typo. Investors are also warned that we do not want humans to have the same fate as dinosaurs, which is a fair point, I suppose. It's the kind of sentence that gets you excited about what the risk disclosure section will look like. The document then outlines a string of future business lines that read like science fiction. They include long-haul, point-to-point terrestrial travel, which I think means traveling around the Earth in rockets rather than airplanes, in-orbit manufacturing, yes, in orbit, passenger and cargo transportation to the Moon and Mars, manufacturing and energy production on the Moon and Mars, and asteroid mining, because why mine for resources on Earth when you can chase down an asteroid in the hope you'll find useful minerals on it? The acronym AI appears over 200 times in the document. The word consciousness appears 10 times. The word profit appears somewhat less frequently than either of those. What we're looking at is quite possibly the most extraordinary document in the history of American securities regulation, and today we're going to go through it because every single thing I'm about to tell you, no matter how absurd it sounds, comes directly from the filing. If you've been following SpaceX for the last 2 decades, you probably think of it as a rocket company. In recent years, with the rapid expansion of Starlink, you might have updated that to a satellite internet company. But if you read the IPO prospectus, you're in for a surprise. SpaceX is now apparently an AI company. According to the document, 93% of the company's total addressable market is attributed to AI. And based on the capital expenditure breakdown, roughly 60% of all spending is now going into artificial intelligence infrastructure. The prospectus breaks the business into 3 segments: space, connectivity, and AI. In the first quarter of 2026, the space division, the part that actually builds and launches rockets, lost $662 million. The connectivity division, which is Starlink, turned a $1.1 billion profit. The AI division lost $2.5 billion in just the last 3 months. The only division that makes money is the satellite internet business. Everything else loses money. When Musk says this is an AI company, what he means is that the one business that actually works is subsidizing a money-losing AI venture, while he tries to convince public market investors that the money-losing AI venture is the entire reason the company is worth $175 trillion. If we look past the talk of extending consciousness to the stars and focus purely on the income statement, the financial reality of SpaceX is bracing. In 2025, the company generated $18.7 billion in revenue. That's a lot of money, but at a proposed valuation of $1.75 trillion, SpaceX is asking investors to value it at almost 100 times its revenue. If SpaceX were dropped into the S&P 500 today, it would be the 7th largest company in the index by market cap. But if you ranked it by actual revenue, it wouldn't even crack the top 200. It would be down near Kellogg's, the maker of Fruit Loops. You get the point. Unlike Kellogg's, SpaceX is not profitable. Space exploration is simply a tougher business than breakfast cereal. Last year, SpaceX posted a net loss of $494 billion. What makes this number remarkable is that Starlink actually generated $4.4 billion in operating profit, which means the rest of the business ate up more than $9 billion in a single year. Since its founding, SpaceX has accumulated over $37 billion in losses, more than any other company that has ever gone public in history, and there are no signs of the cash burn slowing down. Capital expenditure reached $20.7 billion last year, quintupling from 2023, driven by Starlink expansion, Starship development, and AI infrastructure spending. To fund all of this, the company is carrying $29 billion in debt, including a $20 billion bridge loan taken out in March 2026, 8 weeks ago. So when investors hand over $75 billion in this IPO, a meaningful portion of it may not be going to orbital data centers or a Mars colony. It goes straight back to the banks that lent SpaceX money 8 weeks ago. Now, to be fair, the company is growing. Revenue is up somewhere between 33 and 43% annually, which is genuinely impressive. But that growth is coming entirely from Starlink, not the AI business. And even that growth comes with a caveat. Starlink's average revenue per user has fallen by around 18% since 2023, as the company discounts aggressively to boost its subscriber numbers before the IPO. Back in April 2018, Gwynne Shotwell, the president of SpaceX, stood on a TED stage and made a promise. Within a decade, she told the audience, people would be taking 30-minute rocket trips from New York to Shanghai. These rockets would compete with long-haul airlines, making up to 10 flights per day. That decade expires in under 2 years now, which is not much time to figure out how to safely replace the jumbo jet with a reusable ballistic missile that requires passengers to withstand 3 Gs at takeoff. If you were paying attention earlier, you may remember the phrase long-haul point-to-point terrestrial travel from the prospectus. That is this product. It is still being pitched to investors as a future revenue stream. There's no sign of a commercial commuter rocket, and there are under 2 years left on the clock. In the list of yet-to-be-realized business lines, there's a section on payment processing. X, Elon Musk's Everything app, has been talking about becoming a financial services platform for several years now. It has secured money transmitter licenses in a handful of US states, but it doesn't have a functioning payments product yet. So SpaceX is now partially in the business of filing paperwork with the Nevada Department of Business and Industry in pursuit of the dream of processing an $8 peer-to-peer payment on a rocket company's social media platform. SpaceX claims its total addressable market is $28.5 trillion. This is larger than the entire GDP of the United States and almost entirely built on businesses that do not yet exist. As the Financial Times Lex column put it, markets have rarely had to price a stock this speculative at this size, which is probably worth keeping in mind. According to the prospectus, enterprise applications of AI make up 80% of SpaceX's total addressable market, meaning they expect large businesses to pay for Musk's AI tools to improve productivity. Add in consumer AI, and the total AI share of the claimed addressable market rises to 93%. So 93% of the company's claimed value rests on Grok. Now it's worth asking which enterprises are currently using Grok. From what I can tell, the primary documented use cases for Grok are fact-checking tweets and generating non-consensual nude images, which have resulted in regulatory investigations in Spain, France, and the UK, and at least one ongoing lawsuit. Not exactly the enterprise productivity pitch I was expecting. The filing effectively concedes that the enterprise AI market is dominated by OpenAI, Anthropic, and Google. SpaceX's own AI product, Grok, holds a market share of roughly 3.4%. According to Bloomberg, SpaceX's own engineers have been slow to adopt Grok for technical work because it underperforms rival tools. Last month, Musk himself said the AI code would need to be rebuilt from scratch, shortly after he sold xAI to SpaceX for $250 billion. His solution to Grok's weakness in coding was to attempt to acquire Cursor, the tool his own engineers were actually using, for $60 billion with a $10 billion break fee if the deal falls through. The company, whose AI product represents 93% of its claimed addressable market, has a flagship tool its own engineers won't use, and is spending $60 billion trying to buy a competitor just to make it work. SpaceX's near-term AI revenue story rests substantially on a $15 billion a year deal to rent compute capacity to Anthropic, one of the very competitors whose existence proves that Grok is losing the AI race. So SpaceX is basically a space-based CoreWeave. If SpaceX were genuinely going to be a dominant AI company, it would need that computing power for its own models. If Volkswagen were renting out all of its car factories, would anyone still describe Volkswagen as being in the car business? The more pressing problem is that this $15 billion a year contract, roughly 40% of projected near-term revenue, can be cancelled by Anthropic with 90 days' notice. SpaceX's entire AI business model at the moment is renting GPUs to a competitor on terms that can vanish in a fiscal quarter. If SpaceX's total addressable market is $28.5 trillion and 93% of it is AI, then by SpaceX's own logic, the leading AI companies must be worth vastly more than SpaceX. Anthropic's quarterly revenue is already roughly double SpaceX's entire AI segment revenue. Both Anthropic and OpenAI are reportedly filing for IPOs at approximately $1 trillion valuations, and yet SpaceX wants $1.75 trillion on the basis of a market its direct competitors are winning. Now, if you've been wondering exactly who is buying the Tesla Cybertruck, the SpaceX prospectus finally provides an answer. It turns out it was SpaceX. According to the filing, SpaceX purchased $650 million in goods from Tesla last year, including $131 million spent on Cybertrucks, all at full retail price, no volume discount, which is notable given how hard Tesla has found them to sell. That works out to roughly 1,500 vehicles. At one point in the fourth quarter of 2025, SpaceX single-handedly accounted for 18% of all Cybertruck registrations in the United States. Using shareholder money from one company you control to support the sales figures of another company you control, right before both companies face major financial events, is generally considered less than ideal corporate governance. There's also a small accounting discrepancy worth mentioning. SpaceX reports buying roughly $650 million of goods from Tesla last year, while Tesla's own filings report selling $573 million of goods to SpaceX. So somewhere between Austin and Boca Chica, $77 million seems to have fallen off the back of a truck, presumably a Cybertruck. But a few thousand overpriced pickup trucks are the least of the related party concerns in this document. Antonio Gracias is a longtime Musk ally and a sitting member of the SpaceX board of directors. He also runs a private investment firm called Valor Equity Partners. According to the IPO prospectus, SpaceX and xAI are carrying more than $20 billion in AI infrastructure lease obligations tied to agreements with entities connected to Valor. Some of these deals are structured as what accountants call failed sale leasebacks. Normally, in a sale leaseback, a company sells an asset to an investor, gets cash up front, and leases the asset back, removing it from the balance sheet. When the transaction fails to qualify as a genuine sale under accounting rules, the asset stays on the books, and the associated payment obligations get recorded as debt instead. The practical effect is that SpaceX is carrying billions in obligations to a firm run by one of its own board members, recorded on its balance sheet as debt. It is, once again, not considered good practice for board members to hold billions of dollars in high-interest financial arrangements with the company they're supposed to be overseeing. Back in 2016, Elon Musk used Tesla shareholder money to acquire SolarCity, a struggling solar company that he also chaired and partly owned. To help justify the deal, he staged a public demonstration of SolarCity's solar roof tiles during the acquisition negotiations. The tiles were later found by a Delaware court to have been inoperable and far from ready to go to market at the time of the demonstration. The court reviewed the entire transaction under its strictest standard of scrutiny, describing the process as deeply flawed and noting Musk's apparent inability to acknowledge his clear conflict of interest, then found the deal fair anyway, largely because 85% of shareholders had approved it and Tesla's stock subsequently rose. The judge declined to award Musk his legal costs, which is the Delaware Court of Chancery's version of a strongly worded letter. Musk later had a falling out with Delaware over his Tesla pay package and reincorporated in Texas. He has now completed a structurally similar acquisition, this time of XAI, in a state with far more lax securities rules. In Texas, to bring a derivative lawsuit against SpaceX, a shareholder must own at least 3% of the company. At the current valuation, that's approximately $52 billion worth of stock. To win any lawsuit, they must prove not just a breach of fiduciary duty, but specifically fraud, intentional misconduct, or a knowing violation of law. A conflicted transaction, even one with no independent oversight whatsoever, does not meet that standard on its own. And if you wanted to go looking for the internal emails that might help prove fraud, the way shareholders did so effectively in Delaware, Texas corporate law now explicitly excludes emails and text messages from shareholder document requests. When Tesla reincorporated in Texas, Governor Greg Abbott posted on social media to personally congratulate Musk, which gives you a reasonable sense of the regulatory environment there. The lesson Musk appears to have drawn from SolarCity isn't "don't do conflicted acquisitions," it's "do them somewhere with friendlier courts." The clearest beneficiaries of this acquisition aren't the SpaceX engineers trying to get to Mars. They're the venture capitalists and banks, including Morgan Stanley, who were initially stuck holding billions in underwater debt from Musk's chaotic buyout of Twitter. Thanks to the XAI SpaceX merger, those lenders have been made whole in SpaceX equity, conveniently timed just before the largest IPO in history. Historically, investment bankers won IPO mandates by demonstrating deep sector expertise, long-term advisory relationships, and a willingness to work extremely long hours. It used to be quite a dignified business. This time around, Goldman Sachs CEO David Solomon, known as DJ Sol, reportedly boasted to the press that he secured the lead left position on the largest IPO in history by having his staff help him send Elon Musk a direct message. Morgan Stanley, which had cultivated a relationship with Musk for years through banker Michael Grimes, is listed as co-lead. Its name appears second, directly after Goldman Sachs, in what the bank was apparently furious enough about that SpaceX was forced to explicitly clarify in the term sheet that the listing order is purely alphabetical. 23 banks have crammed their names onto the cover of this prospectus. The fees represent the most lucrative Wall Street IPO payday ever. The clearest evidence of enterprise usage of Musk's Grok AI may well be the licenses Musk is requiring his lead IPO bankers to buy. All of this brings us to the corporate governance structure of SpaceX, which is perhaps the most heavily fortified dictatorship ever brought to the US public markets. The company will have a dual-class share structure. Regular investors get Class A shares carrying 1 vote each, while Elon Musk gets Class B shares carrying 10 votes each. Although Musk owns only around 41% of SpaceX, he will control more than 85% of the votes. meaning he can never be removed by shareholders. The company has also placed limits on how shareholders can bring legal challenges. As SpaceX writes in the prospectus, this will limit or preclude your ability to influence corporate matters and the election of our directors. On top of that, because Elon Musk reportedly convinced Nasdaq to change its index inclusion methodology to accommodate this listing, SpaceX will be fast-tracked for inclusion in the Nasdaq 100. This is a massive deal. The Nasdaq 100 is tracked by over $600 billion in passive investor money. By fast-tracking SpaceX into the index, countless pension funds and passive investors will become forced buyers of the stock almost immediately, long before there's any serious price discovery. And they'll own shares in a heavily cash-burning company where they have no voting power and virtually no ability to sue management. Musk has ensured he will never lose control of SpaceX. The filing reveals the creation of a new Class C non-voting stock, which exists so SpaceX can acquire other companies in the future using that stock without ever diluting Musk's voting power. And if he ever decides to step down, he can place his super voting shares into trusts and pass them on to his children, ensuring dynastic control. Finally, there's his compensation package. You've likely read that Musk is getting 1 billion performance-based restricted shares, which vest only when SpaceX establishes a permanent human colony on Mars and hits a $7.5 trillion market cap. SpaceX explicitly describes the achievement of these milestones in the prospectus as improbable. This isn't a sudden burst of candor from management, it's an accounting trick. Under accounting rules, if the company admitted it was probable Musk would receive these shares, it would have to expense the full value of the award, potentially hundreds of billions of dollars, on its income statement today. By categorizing the grant as improbable, it gets booked at zero cost. But here's the catch. As law professor Ann Lipton points out, Musk doesn't actually need to achieve any of those hard-to-reach goals to benefit. He gets the utility of the shares immediately. He can vote them today. He can collect dividends on them today. And with the approval of a board he entirely controls, he can pledge them as collateral for loans to access tax-free cash today. He gets all the benefits of ownership immediately, based on a Mars colony the company itself admits he will probably never build. Perhaps the most extraordinary line in the entire prospectus is this: SpaceX has renounced certain corporate opportunities that may be presented to Mr. Musk and certain of our directors and their respective affiliates, and such persons may have no duty to present such opportunities to us. In plain terms, nothing stops Elon Musk from setting up a separate private company tomorrow to pursue whatever the next big trend is, rather than doing it inside SpaceX, which, if you remember him once calling Tesla an AI company and then immediately starting a separate competing entity in XAI, is a fairly relevant risk. As Professor Lipton put it, public shareholders in SpaceX will have no votes that matter, no ability to sell at a fair price discovered through normal market mechanisms, and no ability to sue the company for wrongdoing. No votes, no sales, no suits. There's one technology at SpaceX that everything else depends on. Not the AI, not the satellite internet, not the Mars colony. Starship, the largest rocket ever built, is supposed to be the key to everything. Cheaper launches, bigger Starlink satellites, orbital data centers, a city on Mars, the NASA contracts. Without Starship, the entire $1.75 trillion story falls apart. Barron's wrote that the recent Starship launch was a bigger deal for SpaceX than the IPO filing itself. The latest version of the rocket was supposed to launch before the IPO filing, but that launch was postponed, then rescheduled for the day after the filing, but technical difficulties pushed it back again. The problem is that Starship still hasn't consistently worked. It remains largely in the rapid, unscheduled disassembly phase of its development, and has yet to carry any meaningful cargo to orbit. As Barron's rightly notes, this launch really matters. The entire investment thesis is built around Starship achieving what SpaceX itself calls an insane flight rate, hundreds of launches per year, each carrying 200 tons into orbit. Starlink version 3 satellites, which are supposed to provide 20 times the capacity of current models, are too large for existing rockets and require Starship. The orbital data center concept requires Starship to launch roughly 1 million satellites. The Mars colony requires Starship to work reliably enough to transport 1 million people who, presumably, want to go there. If Starship fails to deliver, if the flight rate comes in at half of what's promised, if reliability is lower and costs are higher, the entire valuation collapses. The $175 trillion figure assumes Starship works exactly as advertised, on schedule, with no technical setbacks. History suggests rockets rarely work exactly as advertised, so a company claiming to be worth $175 trillion is depending on a rocket that hasn't yet figured out how to land reliably without exploding, which is, itself, a risk worth noting. IPO prospectuses are required to tell investors specifically what the company will do with their money, known as the use of proceeds. Commentary from Cape Fear Advisors points out how much digging, including through the footnotes, is required to grasp the full picture of SpaceX's use of proceeds. The IPO is expected to raise between $50 and $75 billion, add up all the commitments buried in the document, and the company needs approximately $235 billion over the next few years, between 3 and 5 times the IPO proceeds. In other words, this IPO isn't the end of fundraising, it's just the beginning. Bloomberg columnist Matt Levine, in his Money Stuff newsletter, offered a useful way to think about the investment case. If you're buying SpaceX stock hoping to influence what Elon Musk does, that's not going to work. If you're buying it for exposure to a space and AI business while having doubts about current management, that's probably not going to work either. But if you're buying it because you like Elon Musk and want to go along for the ride with him, that actually is the investment thesis here. Share this with someone who needs to hear it. Financial education is one of the most valuable gifts you can pass on. Like and subscribe, and thanks for watching.